Everybody knows what value is doing now. Everybody knows what the idea of relative value looks like. But still the problem is, well, when? You know, we've got a starting point on a chart here. And from that starting point, value starts going up and price goes down, and you say, is that the trade? And value goes up and price goes down, and people say, is that the trade? And value goes up and price goes down, and people say, is that the trade? And all of a sudden they found that they tried to do it here, they tried to do it here, they tried to do it here, and they're losing money all the way through that process. Their timing is all wrong. And the thing that Reeve's mentioning is something that helps Reeve with timing. Something that you need to then say, well, how do I know which one it is? Well, you've got to have a structure, you've got to have a process for timing the trade. You've got to have a process for timing a trade so that you've got your best possible chance. And what is that process? Well, you could use the magic 8-ball. You could absolutely roll a dice and hope for a bit of luck. But you've got to have something that triggers a response somewhere, right? If I said to you can you time the Dow Jones? Can you time the Dow Jones on a buy trade here? What's the answer? Well, I need to see something that's going to really catch my eye. I need to see something that's going to catch my eye to time the Dow Jones as a buy trade, right? Something's got to happen that tells me that somebody's interested in the bit of a business end, right? So let's see if we see what happens that might be a buy opportunity. I don't know if anybody's seen anything that looks interesting, but there's a little clump of activity here that maybe catches your eye, and you say, you know what, I'm going to take a pop at that, and what happens? Nothing. It doesn't ever go bullish. And as the price drops down, you can see that's not obviously significant. Significant in the Dow Jones is something like 100 plus on a 30-second chart. Well, 20 isn't significant, so that's not really something that you would be looking at and going, yeah, that's obviously got to be the buy trade. Why? It's only 20. And as the price drops, the question is, oh, there's a 2. Not really that significant, is there? There's not really something that's crying out for your attention at that point as a 2 lot, right? I wonder if that catches your attention. Does this catch your attention? Does 103 block trade catch your attention as a trader? Is that something that stands out as an opportunity to lean against that as a deal? Because that's a commercial buyer, guys. That's somebody that's a passive commercial buyer. We know that. But it is a commercial buyer that's sitting passively on the book holding, followed by some real money buying coming in behind it, perhaps. That's why the price of the candle went green straight after. You've just timed your trade now, haven't you? You might have been having value since 2:30, since the trade started. You might have found value. The value line might have been going straight north. That might have been happening to your value, but until you see somebody taking action on the value, who the hell are you to trade on your own like a retail, like a commercial trader? You're not Goldman Sachs. You're not Goldman Sachs. You don't have that 1,000 lot to put on the deal. So you've got to wait for Goldman's to turn up. You've got to wait for them. The people at Goldman's would say that you should open the door for them, but you know, they can slam the door in the face for all I like, but you've got to make sure you see them, at least. There they are right there. There they are at the bottom edge doing their business. And now you can say, you know what, that's all I need. That's all I need. So the luck's gone. The magic 8-ball's gone. And it's been replaced by an actual market-derived piece of information, right? A market-derived piece of information saying, Well, somebody's active. If you wanted that buy trade, what the hell else do you need to see? Nothing is the answer. You don't need to give it a good shake. Well, you can give it a good shake and then come back to your desk. But what I mean is, you don't need to shake the magic 8 ball and hope for the best. You've now got your bit of business, right? And there's your buy trade. Look, there's your buy trade. Off she goes. Beautiful, right? It's just timing that entry part of the process, getting the right piece of information that you as a trader say, I need that information. I need to know that it's there so that's what I'm going to lean against if I see it. If I don't see it, I'm not got anything to lean against. I could be buying all the way down a channel, buying all the way down a channel. And that's what you've got to try and put into that context, haven't you? Well, that's not a problem, Rick. If the first big volume doesn't stop the market, you don't buy when you see the first big volume. You buy when the buyers come in behind the first big volume. When the book comes in behind the first big volume, that's when you buy it, not on the way down. Well, Sam's right. The commercials are buying all of this. The commercials started the buying process probably here, Sam. The commercials bought that part there at 520s, and they traded this 40 tick range as a buy trade opportunity. So the commercials would have been buying through that whole phase. They don't just buy once. They buy here, they buy this candle, they buy that candle, they buy that candle, and if the selling keeps coming, they just let it go as far as they want to let it go, right? And obviously the takeaway from that was delicious. I mean, you get a very, very good response to that after the price then ran along that volume node. Remember, you already knew about this volume node because that's the one you thought about in the first instance. But remember, Rick, you remember the class I did, the 3 steps to heaven? Step 1 is where the commercials take their profits. Step 2 is where they start accumulating. Step 3, you kiss and hold her tightly. But that's alternatively what happens at step 3 is, and not to be confused with third base, is what happens in step 3 is you buy the bottom edge or you sell the top edge. When we get to third base down here, you're starting to do the business here, right? Now you want to press the button because you've seen the trade developing once, twice, 3 times into the bottom edge. You want to start heading into that trade route. You want to start lifting the offer with everybody else because now somebody's absorbing the bottom print, right? Then obviously the takeaway from that is that we then get the cappers coming in, the buyers coming in at the capper level. And then the takeaway from that was this brilliant rally away from that price print, look. So you're timing it based on this accumulation process. You're timing it based on the logic of an accumulation in the background. And the takeaway from that trade was just beautiful. Perfect timing, perfect narrative, perfect storyline in the background. And that's all you can ever do. You can only try your best at timing these trades. You're obviously wanting to make sure that when you're going to do a bit of business, this becomes quite selective because if this guy doesn't show up, you miss the trade, right? But that's why you've also got access to things like Voltic tools. A big surge in Voltic or a big surge in volume becomes something you can also access during these types of phases. There's a lot of good volume tools that you can add into your trade vocabulary. Things like the time segmented volumes, the demand index, the OBVs, and those types of things that help you to find that beautiful executable bottom edge. And when you find that executable bottom edge, you've now got the opportunity to really do some damage on the deal, right? you should never be buying or selling a market that hasn't got a volume divergence unless you're trading like a commercial, unless you want to be that hero that props up every market move and and that type of thing. And this is why we use things like OBVs and demand indexes and time segmented volumes and all the various other ones, because unless you've got that volume divergence, you shouldn't be anywhere near the trade for a buy trade anyway. The bottom edge of equities was a very, very good example. When this buy trade showed up on the Dow Jones, you can see exactly what was diddling in the background. You'll see exactly this when I show you what was happening, right? So let's take a look at OBV against the Dow Jones, okay? So here, well, it's not against the Dow Jones, it's against the S&P, but same trade basically, right? Exact same bottom edge. So when the OBV makes higher highs here, there's no way you can sell that phase. It's too much buying, so the obvious commercial response to too much buying is to let the price go higher, correct? Everybody on board? All aboard? This short-term rally here, we don't know how far that's going to go, so we are not sure about that. So in other words, we've got to see divergence before we know we have divergence. We can't make it up on the right-hand edge. We've got to actually have seen it in the left-hand side of your channel, right? What do I mean by that? Well, this is the problem with people in real-time divergence trades. If I look at a real-time volume divergence, if I'm looking at this chart here and I say, where are you going to bid? Where are you going to bid for this? And I draw the volume doing this. And I draw the price coming up like this. So the volume starts diverging. And I draw it down, back down like this again. I haven't seen that divergence yet, have I? You might say, yes, you have, because the price is a lot lower, but this is a lot higher. Yeah, but in hindsight, this red line, which is time segmented or OBVs or demand indexes, could easily make a lower low, couldn't it? So until that doesn't make a lower low, Rick, until it actually shows divergence, that's not going to be divergence. We're not going to call it a divergence yet at that stage until it actually physically shows us divergence. What does that help us with? That helps us to count to 3. Because now I can see that divergence. What's probably happened in price is we've probably had a little spike there and then the price has dropped down again, right? So that on the move down here, that's not divergence because we don't really know how far that's going to go just yet. It might just be early in the process. It looks like divergence, but it's not quite divergence yet. So we've got to actually be able to see the divergence, physically see the divergence forming, Rick, before we can do anything about it. So for example, at the top edge of equities, we actually can see the divergence in the volume sequence, this big rally in volume and price, and then this rally in volume and price. But the volume was going up at that stage. That's not actually divergence in my world at that point. It looks like it might become diverging, but that volume might just start really building as the price goes higher. So until that actually physically shows me something that I can draw a dotted line against, until that forms a peak, I'm not going to count this as divergence. Now I have divergence. Now I'm ready to time a sell entry, right? So when I'm starting to look for that sell trade, I'm starting to hunt the volume into the top edges. I'm going to start looking for something in the top edges. You can see obviously the OBV is quite clearly diverging with this big drop off in volumes, massive drop off in volumes at that stage. So I'm going to start hunting for the big volume up here. I'm going to start looking for the big volume. You can see there's a big volume spinner candle right there at 14, 17, and 30 seconds. That was actually the sell trade right there. That was the sell trade there. And there was another one just here. And there's your timing process. And obviously what happened at the bottom edge, you can see that this here, that's heavy volume coming in on the short side. And when we see that sell-off, take a look at the bottom edges in volume terms. So let's get rid of the volume for a second. There's the lowest low in volume into this area here. Lowest low in volume just there, right? So if that's the lowest low in volume, we now need to be able to draw a line against that lowest low, because at the moment, this really isn't doing anything until it turns up, right? Now it's turned well up. At this stage, it's now completely turned up. So this whole process could have been a buy trade because you're reading it as diverging. It's not really diverging. The selling is still coming in. Now we've got a very obvious divergence creeping in. Now, obviously, if the price drops very, very aggressively and the volume drops very aggressively, even if the price is lower but the volume isn't, that's not going to be a trade. But that's not what happened at the bottom edge. And this trade here at 1442, that trade there at 1442, guess what? That's that trade there at 1443. You see it? You see how it's exactly the same thing? And it is exactly the same thing, isn't it? The whole trade just works out in exactly the same way. We're looking at any volume indicator that you want to use, any volume indicator that, you know, as I said, Sammy likes using things like the demand index. But it doesn't matter. They're all almost exactly the same. They're almost exactly the same, guys. Every volume indicator of its type, the way that it's calculated, has exactly the same readings. So, for example, if I put on the TSV in the background, just the same, you'll see that if I put TSV on it instead of OBV, here's what happens. Look. It's exactly the same, isn't it? There's the highest volume there. There's a decline in volume. And there's your opportunity to work that divergence into the bottom edge. There's exactly the same volume read off the bottom edge. Everybody has their own favorites about what they use, and but they're all roughly going to be exactly this. Roughly going to be exactly the same. You can't roughly be exactly the same, but they're all roughly going to be pretty close to the same type of thing because they're all based around just volume and price action, right? That's all they're ever based around, these things. So you're obviously watching that and saying, right, the volume's gone out the trade. I want to try and find a buy trade around about 1441. And then we start looking at the price and we suddenly see this 103 print. And when we see that 103 print, all of a sudden the gamble from that trade is pretty much evaporated, hasn't it? Assuming you want to be in a long trade, that it's no longer a shake of the lottery balls, is it? You know, the magic 8 ball says no. Well, that 103 lot seller that's just been absorbed is now trapped, and that's a real time, real money trade that's happening on your right hand edge of your screens. And ultimately you get this brilliant buy side response away from that price print, guys. So volume is very, very important on these divergences. If you can't highlight a divergence, you ain't got one. When you can highlight a divergence and you're looking for a divergence, that's important, then you can obviously start looking into the markets and start saying, right, I've got the volume coming off the trade. Have I got any value coming into the trade? And then can I lean against something that makes the trade even better? It's that part of that process that you've got to go through as a dealer, as a trader, to make good decisions, good probability decisions at any point on the screens. So you're starting to watch this. You're starting to think to yourself, right, the volume's coming out of this Dow Jones. I want to try and find a trade. Well, if you were obviously leaning against something, that 30 lot could have been a lean, couldn't it? Straight away, you've got something that you could lean against on the 30. It's not exactly 100, but you know, you're obviously looking at that 30 and saying, right, I'm going to take a little lean against that. So what happens? the price goes up from the 30, trades down to the 30, you sell against it there, the price drops, you make a profit, you scratch out, you lean against it again when it drops, and you're still short the Dow Jones. You're selling into that process now against that 30 lot. If you get another failed auction, you know you're going to squeeze the top edge, and you wait for that top edge to happen. You wait for the top edge to happen, and you start all over again. You start the process at the top edge, and you start seeing whether you can get a lean against that anything a little bit bigger than 30, because 30 is a little bit light. We know 30 is a little bit light because, like was mentioned earlier, you've got to know what big volume looks like. You've got to know what big volume is for every market you trade, and that's just about familiarity with the footprint. If you don't know what big volume is, well, how can you lean against something? You need to know that type of information, right? So it's not as big a gamble as you might think. Timing this trade, process for timing the trade, volume coming away from the trade is a great starting point. There's still selling coming in. Commercials will not stop the price dropping.